Hey everybody, it's Dylan Bray. Today my topic is capital budgeting from the learning module Capital Budgets. What is capital budgeting? Capital budget lists the projects and investments that a company plans to undertake during the next period. In order to create this list, firms must go through the capital budgeting process. Capital budgeting is a process of analyzing projects and investment opportunities and deciding which ones to accept and which ones to reject. This process begins with forecast of each project's future consequences for the firm. Some of the consequences will affect the firm's revenue and others the cost. The capital budgeting process. The goal of the capital budgeting process is to determine the effect that accepting or rejecting a project has on the cash flows of the business. In order to do that, it will require accurate cash flow forecasts for each project. Cash flows typically fall into three categories: the initial outlay, ongoing cash flows, and terminal cash flows. The initial outlay is purchase equipment, initial development cost, and an increase in net working capital, which is inventory, raw materials, etc. Ongoing cash flows would be incremental revenues, incremental costs, taxes, and a change in net working capital, which is inventory, raw materials, accounts receivable, and accounts payable. Terminal cash flows would be a sale of equipment, shutdown cost, and a decrease in net working capital, which is again inventory, raw materials, etc. Forecasting incremental earnings. Incremental earnings is the amount by which a firm's earnings are expected to change as a result of an investment decision. It tells us how the decision will affect the firm's reported profits from an accounting perspective. Formulas for computing incremental earnings. Incremental earnings before interest and taxes, or also known as EBIT, equals the incremental revenue minus incremental cost minus depreciation. Income tax would equal the EBIT times a firm's marginal corporate tax rate. Incremental earning equals the incremental revenues minus incremental cost minus depreciation multiplied by 1 minus the tax rate. In this slide, I've put together an incremental earnings example in order to show you the proper steps and formulas to use and where you should be getting the numbers from in order to determine the firm's earnings and how they expect it to change. Thank you for your time, and I hope that by viewing this presentation you have learned a little bit more about capital budgets.